This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Good evening, everyone. I'm Tyler Matheson. Welcome to this special holiday edition of Nightly Business Report.
And I'm Sue Herrera. Tonight, as we sit with friends and family to share a meal and give thanks, we're pretty sure many are looking back on the big changes that our nation has witnessed in just the past couple of weeks.
Well, those sweeping changes began on Election Day when Donald Trump won the White House, but the changes have not been limited, of course, to politics. Since November 8th, the stock market has rallied. Bigly, he might say, sending many of the broad market indexes to levels never seen before. Dominic Chu takes a look at what might be next for the market and your money.
You can't say we haven't had an eventful November in the markets. The election is now behind us, and investors and analysts all over are trying to figure out if that stock rally since the election day has legs into the year end. Well, history may help provide at least a little bit of color as to what to expect as we head deeper into the holiday season. Bulls will point to the generally positive nature in the markets in December. According to data and analytics firm Kensho, over the last 20 years, the large-cap S&P 500 averages a 1.2% gain for the month of December, and it's been a positive month 70% of the time. A seasonally strong December and some other factors have at least some money managers feeling good about the future.
I'm generally bullish because I think you're going to get, as most people believe, quite a bit of fiscal stimulus. And I think that there are securities out there that are more or less neglected that represent good value. And so if you focus on value and we think value comes back, that you can make good money over time.
While utilities and industrial-related stocks have been some of the biggest average gainers in that time span, energy and technology-related stocks have been among the biggest laggards. And there are still a number of market risks to be aware of in the coming weeks and months.
One of the biggest risks to the market over the next several weeks will be the Fed meeting. Investors have built in the expectation that the Fed will raise rates, but we're not quite sure what they're going to say, so all eyes will be on that. Second, we think the market has really been driven by expectations and news out of Washington. So to the extent that that news comes in and doesn't meet market expectations, that represents an additional risk.
But for investors with a longer time horizon, many experts still believe you should take advantage of any market weakness.
I think the most important thing for investors to do is, buy stocks on dips, buy companies that they understand the fundamentals for, and to think long term.
Now that the election is behind us and we're recovering from that Thanksgiving food coma, investors may have a chance to do a little fine-tuning for their portfolios into the year end. For Nightly Business Report, I'm Dominic Chu.
Another big change for your money could come from the Federal Reserve. Many expect the central bank to raise interest rates when policymakers meet next month. That would be the first increase in a year and just the second in a decade. Hampton Pearson takes a look at what might be next for the Fed.
When the Fed looks at the American economy, there is much for which to be thankful. The most recent economic stuffing included new data showing an improving housing market, rising consumer prices, and a still robust labor market. Last week on Capitol Hill, Fed Chair Janet Yellen told lawmakers the economy is strong enough to withstand an interest rate hike, and soon.
Were the FOMC to delay increases in the federal funds rate for too long, it could end up having to tighten policy relatively abruptly to keep the economy from significantly overshooting both of the committee's longer-run policy goals.
The Fed chair's comments bolstered expectations for a rate hike when monetary policymakers meet in mid-December, 1 month before President-elect Donald Trump takes office. Monetary policymakers are also keeping an eye on the president-elect's plans to jumpstart economic growth. Yellen urged lawmakers to choose wisely and don't overlook inflation.
Such a package could have inflationary consequences that the Fed would have to take into account in devising policy.
Leading economists and market watchers say the biggest X factor for the Fed, how quickly the Republican-controlled Congress moves on the president-elect's plans for tax cuts, a major infrastructure program, and the Obamacare overhaul.
So for calendar 2017, there's probably no real news, no real tax cut, no real spending gets out. So they get to execute their game plan, watch what passes the Congress, and then start revising how quickly they have to raise after 2017 and when they have to stop.
And we now know Janet Yellen will remain at the helm of the Fed next year. Yellen telling lawmakers she has no plans to step down until her current term as Fed chairman ends in 2018. For Nightly Business Report, I'm Hampton Pearson in Washington.
So what can we expect from the financial markets, the economy, the Fed between now and the rest of the year and spilling over into 2017? And how could it all affect your investments? Mark Lucchini is Chief Investment Strategist at Janney Montgomery Scott, and Lara Rame is a Senior Economist at FS Investments. They join us now to discuss. Why don't we start, Lara, with the economy and how you see it evolving through the end of this year and into 2017? Why don't you start with what kind of holiday shopping season you expect?
Well, so far the consumer has been very robust. It's really the main engine driving our economy forward. I will be out there doing my part, I have to say, but I think that we're going to see a very strong consumer in the fourth quarter.
I'll be right there with you. Mark, comment on the fact that the market seems to be indicating that the economy is on stronger footing than maybe other people think, and that we're going to have strong growth, and that's why we have seen these new all-time highs in the major indexes. What do you think?
Well, Sue, I mean, we have an element of uncertainty now removed from investors' mindset, of course, and that is the election. And I think much to the counter of what some had expected, the sell-off that was likely to accompany a Trump victory was worn off by basically 11 o'clock the day after the election. And so investors, I think, have gravitated toward this notion that a single-party system is going to enable the enactment, the legislation of some of Trump's propaganda relative to not only a significant fiscal package in the form of infrastructure spending, but corporate tax reform. And I think a lot of that's being pulled forward into equity prices right now. I'm not sure that obviously this kind of rally that we've had in the last couple of weeks is going to be sustained over the balance of the next 12 months. There's plenty of room for an underwhelming policy response or delays along the way. But either way, I think on balance, this is beneficial to equities because on top of a sturdy economic climate, you have the potential for some positive surprise as a consequence of those policy initiatives.
Well, let's talk, Lara, a little bit about your outlook for the economy in 2017 and beyond. Obviously, if there is fiscal stimulus next year in the form of a tax cut or infrastructure spending, that's going to play out over time. What do you think the outlook is for economic growth next year? And are those projections of maybe 4% or greater growth in what they used to call in D.C. the out years, are those achievable, really?
I think it's really important to remember with the election news out of the way that 2017 probably still looks about the same as it did before the election. A lot of the changes that were being discussed and that the robust positive news that the equity market's latching onto is probably more of a 2018 story. The structural challenges the economy's facing, low productivity growth, and a lower labor force growth are still in place. So my forecast is 2% growth in 2017, and that's probably relatively healthy versus our potential output growth. And numbers of 4%, 5% may sound good on the campaign trail, but the reality is when you do the math and add it up, it's extremely hard to achieve that.
All right, so Mark, if I have money that has been sitting on the sidelines until the election was decided, now we know who's going to be in the White House, where do I put that money to work?
Sure, Sue. Well, everything has certainly melted up. But I mean, I think if you poke around the energy sector and the technology sector, there's still opportunities there. I think those both stand to benefit for further economic growth and maybe even some acceleration thereof. I would be patient to put capital to work in a couple of other areas that look really good, namely financials, of course. Another might be the industrial sector that have rallied on the belief that, again, all the things that we had mentioned earlier are going to come to fruition early in 2017 instead at a later or maybe even be 2018 events, and therefore would try to buy at maybe 5 to 10% lower prices than what they're currently offered at. But on balance, I'd be leaning more cyclical than I would defensive, because I think what we're going to see is breeding of an inflationary climate that is going to be counterproductive to those classic interest rate sensitive sectors.
All right, Mark, thank you very much. Mark Lucchini with Janney Montgomery
You're
Scott,
welcome.
Lara Raim with FS Investments. Happy Thanksgiving.
Same to you, Tyler.
And still ahead, what taxes, infrastructure, and energy may look like under a Trump White House. Big changes may be coming to trade. Donald Trump has said that he wants to renegotiate NAFTA and has called the Trans-Pacific Partnership trade deal a disaster. But a Seattle business owner who has operations in Asia disagrees. Eunice Yoon reports tonight from Yangcheng, China.
Far from American politics, Seattle native Fred Crosetto has had to upend his investment plans. A major free trade pact initiated by President Obama was expected to boost his business, making disposable gloves for U.S. consumers. But with the surprise election of Donald Trump, that deal looks all but dead.
I guess all bets are off until we know what happens with the TPP.
The TPP, or Trans-Pacific Partnership, encompasses 12 nations as far-flung as New Zealand and Peru. But the agreement has come under attack by critics, including Donald Trump.
We will also immediately stop the job-killing Trans-Pacific Partnership. That's going to be the next disaster.
Crosetto, who has his gloves made in 5 countries, thinks the TPP would be great for America, cutting prices for consumers and tariffs for U.S. companies in Asia and back home.
There's 18,000 products that are going to come out of the United States into TPP countries, and those are going to be more or less duty-free. And it's an enormous golden age of opportunity for American manufacturers and American suppliers to ship things to Asia. Because Asians have got rising incomes, they want to spend, and they have a high appetite for high-quality products.
All of these products made here in China are headed for North America. But if the TPP passes, chances are more business like this will shift to countries that signed on to the TPP. Crosetto was going to scale back his production in China, which isn't part of the TPP, in favor of Malaysia and Vietnam, which are. With the TPP near death, he now fears his hiring plans back in the U.S. will also stall.
We think the TPP in our particular company is going to generate numerous high-paying jobs, mostly in services, social media, design, sales, and marketing.
If you got a chance to sit down with Donald Trump, what would you tell him about the TPP and Asia?
I would say, look, Asia is a very important place. The United States would really be wise to sit down and say, how can we actively engage Asia, China, because this is where things are going to happen in the next 50 years.
For Nightly Business Report, I'm Eunice Yoon.
The transition to a Trump administration may usher in some major changes, of course, to the country's infrastructure. The president-elect has proposed spending up to $1 trillion over a 10-year period, and the railroads are expected to get a big lift. Morgan Brennan has more.
Here at CSX's Bedford Park Rail Yard, 22 trains loaded with some 1,300 containers move daily on the equivalent of 26 miles of track. It is a huge facility, and it is privately funded by CSX. It highlights the fact that the freight railroads already maintain their own networks, on track to spend $26 billion this year alone. But if President-elect Donald Trump comes through on plans to drum up $1 trillion in infrastructure spending, rails will still likely benefit, as connecting highways, passenger rail tracks, and ports get an update. But the biggest boon would actually be moving the building supplies themselves, increasing volumes at a time when rails have struggled amid a weak freight environment.
We serve the industrial economy to a large degree, and when they win, we win. And there's opportunities here based on what ultimately the policies are going to be for potentially more spending. And that would obviously be helpful for us as well.
But there are many questions that are far from being answered, particularly around trade. If the incoming Trump administration takes a more protectionist approach to trade, upending NAFTA and taking a tougher stance against China, that could have big ripple effects in the North American supply chain. For the U.S. railroads, about 1/3 of total traffic is trade-related, according to the Association of American Railroads, with chemicals, grain, and autos among the biggest groups. Analysts say some railroads would be more affected, particularly those that have benefited from booming trade with Mexico, a growth story in an otherwise tough freight environment.
We're certainly going to see a shifting trade pattern, and that could certainly impact some of the railroads that go across border versus the eastern rails, which would hand it off to other railroads and continue that trade. And does that investment go back into that Rust Belt states where you could see more and more traffic originate from those areas?
And more traffic could come. The president-elect has vowed to reinvigorate coal, which for the rails has plunged by half from a peak of 140,000 weekly carloads in 2008. But while coal deregulations could boost revenues, and certainly the stocks, not even the railroads themselves expect to return to the commodity's glory days. For Nightly Business Report, I'm Morgan Brennan in Bedford Park, Illinois.
When it comes to energy, President-elect Trump has pledged to support increased oil and gas development and a revival of the coal industry. He also wants to ease industry regulations. Jackie DeAngelis reports what impact these potential changes could have on that sector.
Candidate Trump supported relaxing energy industry regulation. If President Trump can achieve those goals, that would benefit the drillers, the frackers, and the infrastructure companies. But it can also increase supply at a time when there's already a worldwide supply glut.
Trump will open up the oil markets and make it more advantageous for exploration and production. The markets will regulate themselves. In other words, if there is too much oil on the market and it's not profitable for them to produce, then those wells will stay shut. And if it is, then they'll come online.
Infrastructure projects are also in focus, especially pipelines to move oil around. Not only will these projects create jobs, but they'll continue to build out the domestic transport network we need to get oil where it needs to go. On coal, Trump won't expand the industry, but he won't make moves to tamp down on it too quickly. The goal would be to keep coal companies and workers in business. Alternative energy was an area expected to thrive under Hillary Clinton. It may not see exponential growth under Trump, but analysts are not expecting alternative energy companies to suffer dramatically either.
The problem that we had before was there was a jump to green when it was not economically feasible for many companies to be able to do that. Fossil fuels are what we use right now. The world does want to go to green, but it's going to be a slow process, not something that we could force on companies.
Meantime, experts say that none of these changes will be made overnight. It's going to take some time to approve and implement them. And when it comes to the energy industry, slow and steady wins the race. For Nightly Business Report, I'm Jackie DeAngelis.
Across the board tax cuts. That's what President-elect Donald Trump has promised. But what does that mean for you and your wallet? Robert Frank takes a look.
Donald Trump's tax plan would put an average of $2,900 a year back into the pockets of average American taxpayers. The highest earners get the biggest cuts, both in dollar and percentage terms. Trump has touted his plan as a way to simplify the tax code and put more spending into the private sector. So the biggest change he's proposing is to cut the 7 current tax rates down to 3. Those would be 12%, 25%, and 33%. Companies get a big cut too, the corporate tax rate going from 35 to 15%. And for those who own their own companies or have partnerships, Trump would allow them to use that 15% rate for their personal income tax returns. He would also eliminate the estate tax, which currently applies to estates worth more than $10 million, and he would cut the capital gains tax. So what does it all mean in dollar terms? Well, if you add in all those tax provisions together, the bottom quintile of earners get an extra $110, or less than 1% of their income. The middle earners get a cut of 2%, or about $1,000, and the top 1% get a cut of 13.5%, or $214,000 a year. And the top 0.1% get a cut of more than 14%, giving them an extra $1,066,000 per year. Now, Trump's plan is similar to that put forth by House Speaker Paul Ryan. so it has a good chance of becoming law. And all that extra cash, totaling trillions a year, could go to improve consumer spending, investing, or saving. Yet there is a price. The Tax Policy Center is saying Trump's plan would add up to $6 trillion to the deficit over the next 10 years. For a Nightly Business Report, I'm Robert Frank.
Dave Prokupek joins us now to talk more about how taxes under President-elect Donald Trump could impact you. He is CEO of Jackson Hewitt. Welcome. Nice to have you here.
Great to be here. Back. Yeah.
You know, Robert Frank kind of detailed some of the major changes, and you say, yes, it's going to be a simplified tax code, but the effects of that are rather uncertain right now.
They are. I mean, we look at it at Jackson Hewitt. We got to stay on top of this all the time, and people don't want to leave any money on the table. But change, even good change, creates uncertainty. So we're looking at simplification. You're going to go from 5 filing statuses down to 2. That's going to make it easier on people. You're going to have only 3 tax brackets. And one of the other things no one's talking about, he's going to have one big giant deduction of $30,000. And so you're going to have a lot of people actually not paying federal taxes this year, especially
That's going to be the standard deduction or the standard exemption?
The standard exemption for married is going to be $30,000. So once you subtract that $30,000 from whatever you make, it's really going to lower your taxable income. And so a lot of folks...
And maybe your bracket.
And your bracket. And so the lowest bracket is going to be down at 12%. Wow. And so a lot of people are going to benefit from these changes.
So it is always good advice, I remember from my days covering personal finance, to accelerate deductions and postpone income. If tax rates are coming down, that advice is even more important this year, right?
We think so. There's a big planning opportunity. The phones are already ringing. So one of the simplest things people can do is just in their charitable giving.
Accelerate it.
Accelerate it. Bring it into this year.
Because that deduction will be worth more with higher rates than it will next year.
So if you're paying 40% this year, you're going to save 40%. If you're only paying 20% next year, so it is worth a lot more. Your bonuses, you would defer into next year. Capital spending. So a big planning opportunity.
I want to be in that category.
Yes.
You could just defer a lot of money.
Absolutely.
Hasn't happened yet. What about for businesses? The corporate tax rate he is proposing to really lower dramatically. That could be a boon to a lot of corporations.
We think so. I mean, he's talking about coming down to 15% and put us on par with a lot of the rest of the world. You know, being a CEO for the last 25 years, I know when you feel confident about what you're going to make, you're going to spend more money generally. And so it's a boon. If you own apartment buildings across the board, people should have more money to spend and invest.
Let's talk about capital gains rates. Those, I believe, are proposed to come down as well. Should I postpone selling an asset this year in anticipation that the rate may come down next year?
I think that as long as we're at the end of the year, and unless you're sitting on a transaction, it would appear to wait. You have a lot of families and folks with really low basis assets that you could see them selling into next year because they view it as a generational low in terms of where capital gains rates are going to be.
All right, Dave, thank you so much. So glad you could be with us. Happy Thanksgiving.
Happy Thanksgiving to you. Thank you.
Fantastic.
David Prokupek, with Jackson Hewitt.
All right, coming up, did you eat too much for Thanksgiving? The fitness industry has some new and very creative ways to help you burn off the burn.
Overeating at Thanksgiving is common, way too common. Some say it's a tradition. So if you had too much turkey or an extra helping of pie, you're probably wondering how you can burn off those extra calories. The ultra-competitive fitness industry has some ideas. Diana Olick shows you the ropes, literally.
That actually feels really good.
Whether you're hanging from the ceiling or bouncing off the walls, you're definitely not bored. And that's the strategy behind new fitness offerings in a space that is getting increasingly crowded.
How important is it to really mix it up?
So important. I think nowadays
The students are getting much smarter. They're getting much more educated about fitness and wellness on all the different offerings. So it's always important as a business to constantly innovate.
At Spark Yoga in Arlington, Virginia.
Drop your toes towards the floor. Drop it towards me. All right, nice. Point your toes. And then coming into Vampire.
They're taking your downward dog up in the air, strengthening both core and grip and decompressing your spine.
Stand up, drop your weight into the fabric.
But more than that, they're attracting people who just want something new.
There's so much you can do between cycle, bar, yoga, aerial yoga, everything. And so I just try and keep switching it up to stay active and not get bored with anything.
You come up and over, tap your foot, tap your hand. You have 1, 2 each side.
Impossible to get bored at AG6 on Manhattan's Upper East Side. It's something like a human video game where you follow the lights on the floors and walls, working both body and brain.
It's ridiculous. I have never sweat so much, worked out so hard, and felt so tired when I was done.
The technology is by a Spanish company, Pavigym. They started in flooring, but have now put in over 30 of these workout studios, mostly across Europe. They tell me they will double that in the next year.
We've fielded a ton of calls, a lot of people who are really interested in the technology. Now it's up to them to head over to Spain, check it out for themselves, or even come here and then make the investment.
The system costs over $100,000, but the payoff could be big, because in fitness today, if you build it and flash it up, they will come. For Nightly Business Report, I'm Diana Olick in New York.
That does it for this holiday edition of Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thank you as well. Have a great evening, everybody. And don't forget that the market is open for an abbreviated trading day tomorrow. And we'll see you then.